Welcome back to another episode of Retired Right. Today I'm joined by the founding fathers of financial planning, Ron Wyatt and Nick Lewandowski.
He's the founding father.
I'm the grandfather, you're the father.
Yeah.
I was trying to come up with like a new nickname today. Some of them will stick, some of them will land, some won't. But no, we appreciate you tuning in. This episode, what we're going to focus on is the difference between financial advisors that work with their clients in an ongoing way or more of like a comprehensive approach as compared to advisors that work with their clients maybe on more of like an hourly basis or a shorter term period of time.
Like a fee for plan.
Yeah, fee for plan. So you might, engage with them for X amount of months and get X amount of meetings in that time period. So we're just going to compare some of the pros to each and some of the cons to each. This is at least from clients that are, or prospective clients I should say, that are searching for an advisor. This is something that is brought up frequently, so we figured putting an episode out there that just explains the differences would be helpful. So why don't we just jump right in? Let's just focus on, what I'd like to do first is actually just give some background context on the differences between the two. So whoever wants to take it first, can you just explain, maybe in a little bit more context than we already have, what that hourly financial planning model looks like?
So there's two major types of ways that you can pay for advice. One way is to pay a fee for a plan, and the engagement may last 1 year and then that's it. The other way is a fee based on assets under management, which quality firms will not only manage money, but they also do planning within that all-encompassing fee.
What you're saying is under the comprehensive model, it's ongoing, you're paying one fee that's covering every service that firm has to offer. Under the hourly planning model, it's or fee for plan model, it can be a specific amount of time, or it can be by the hour, and typically you're paying more just for like a financial plan.
Yeah, you're paying for normally a plan, right?
Okay, so let's start with on a deeper level comparing the pros and cons to each. So when I think of some of the positives to the hourly planning model, one is that I think it's potentially more cost effective. Could you guys break that down?
I have a personal story that can help bring this home. So my father listens to the show. Hi, Dad, if you're out there. He is the classic engineer personality type. Loves doing his own financial planning to the point where he went out and bought his own consumer grade financial planning software to build and update his own plan.
Okay.
But one of the things that he basically is his own advisor in that sense. But one of the things that he was interested in doing because of research he'd done and an analysis he'd done and his risk tolerance, he decided that he wanted to annuitize a portion of his portfolio to just create an income stream as part of his own personal retirement planning. Mm-hmm. He didn't want to pay someone for ongoing advice because he does that himself. It's like his retirement hobby to an extent. So he worked with someone, they agreed on a project fee to just be a second set of eyes, and then he happily paid a commission on the annuity project. So he had a little bit out-of-pocket fee for a second set of eyes and some analysis to confirm that his numbers weren't way off. And then that was it. There was no ongoing engagement beyond that. So in my mind, that was a good example of where it worked very well because you had someone that didn't really have a need for ongoing planning advice. He was basically working as an advisor himself and had that deep analytical desire, but there was a one-off need for a specific thing. And so that was the best balance of cost for him. Yeah,
and I think that actually perfectly blends another positive side of the hourly planning model. In the story that you gave, your father had one very specific need that he was able to identify, and that's kind of like a one and done type recommendation. So for that, yeah, like, you don't need to, if that's all you want, you don't need to pay somebody ongoing.
Yeah, we would not be appropriate for that.
Like we wouldn't be a good fit for that. We're reviewing things several times per year, every year.
Right.
That's a one and done thing. So that's again going to be another positive with the hourly planning model. If you have one specific need, whether it's the annuitization of a portion of your portfolio, maximizing your Social Security benefits, a recommendation with, do you take a pension lump sum or do you take the income, and what are the survivor benefits on there? Like those are again like one-time decisions that I think fit very well into the hourly planning model.
Correct.
One other thing, Ron, maybe you can talk about this, but another benefit to the hourly model is that the conflicts of interest when it comes to investments tend to be very limited, if not completely eliminated. And can you just maybe give us some additional context there?
Sure. Normally with the hourly, you're not, the firm's not managing money. And so they'll just oftentimes provide you with an allocation that they think makes sense, and it's up to you to implement. So yes, there's no conflicts because they might not be getting paid to, anything to sell product to you, but at the same time, you end up being responsible for the management of your money. And just like Nick said, and this is my experience, certain people who, think that they may be very good or think they're very good at investing, might opt into the hourly model because they want to handle the investments and they want someone to check now and then on the planning part.
Right. And I don't have this necessarily listed, in like the show notes as a con to the hourly planning model, but I would want to say that to what you said, there is a flip side. And I would say the flip side, you could probably throw that on the cons list for the hourly planning model. The flip side is, the hourly planner, they may give you a suitable asset allocation recommendation. Like maybe they'll pick 3 or 4 funds that give you a good amount of diversification. They put you in X amount of stocks, X amount of bonds, but seldomly are they going to be the ones that are making sure that those recommendations are implemented. And most definitely, they will not be doing the ongoing monitoring. So, if you have a couple years like we've just had where, U.S. stocks are rising, all of a sudden, if you're not in there and trimming back on that risk in an intelligent way, now your portfolio, they made a point in time recommendation, but now your portfolio looks completely different than when they first made that recommendation, and it falls on you to bring it back in line with the original plan.
Yeah, and sometimes they don't even provide specific product recommendations. Sometimes they just say, here's an allocation that makes sense.
Right.
Go ahead and do it.
Yeah. All right, so let's look at some of the downsides to the hourly planning model. One thing that I would say, and I keep on saying hourly planning model, I'm using that as a synonym for whether you play a flat fee or you're paying somebody hourly. But one of the other cons I would say is that the cost can actually be unpredictable depending on if they're charging an hourly rate or not. Just think about it. It's if your situation is complex. Let's just say that maybe you fall more into the category of needing some comprehensive ongoing advice, and the advisor kind of sees that. Well, that's going to require them to do more work and spend more time. And obviously, if that's the case, you're going to be paying more.
Yeah, there could be a little bit of a conflict because if they're paid an hourly fee, they may want to work more hours.
It could incentivize inefficiency.
Yes.
Yeah.
And even without that conflict being in play, I think one thing that we see all the time when we work with people is like, people come to us and a lot of times they think they have a simple, straightforward question. And a very common one is, what should I do about my IRA RMDs?
Good point.
And they think it's a 2-second answer.
Yep.
But it's actually an onion that you have to peel, because to make that recommendation, you have to dig into all the other areas of the plan. You have to understand the taxes. You have to understand what are all their assets are positioned. You have to understand the investment allocation. And so if you're doing that on an hourly basis, you may come into that thinking that, $500 an hour, I'll talk to them in an hour, my problem's done, $500. But by the time the onion gets peeled and they have the information and the analysis to actually give a quality recommendation, like you were saying, Ryan, it could be several times what you initially thought.
Because if you start, they say, for example, you meet 5 years before RMD start, you might it might be appropriate to do Roth conversions to save taxes while you're alive, and then make your estate more tax efficient, and that whole project can take a lot of time.
Yeah. And I mean, I see this happen all the time. We only work with clients on ongoing. We used to have a flat fee model, but we didn't feel like our true value add was there, so we completely stepped away from it. But something that I see happening all the time is a client will ask us a question, like Nick said, when we're going through their financial plan, and they might think that it's, like you said, a pretty straightforward question, but what really happens is that retirement planning, like think of a bicycle wheel and think of all the spokes that are on a bicycle wheel. Everything is connected. So if you have one question in this one little area, a bicycle wheel is not going to work with just one spoke. That tends to lead into many other areas, and so it's up to the advisor to know, hey, this question connects to all these other areas in their plan, and to not only answer that question, but make sure that whatever they want factored in the plan is addressed in every other area: taxes, investments, risk tolerance, etc. So everything is connected, and I would say that is kind of the final con that I wanted to talk about with the paying a fee for planning or the hourly model, and it tends to be less suitable for people with comprehensive planning needs. So I know that
or ongoing
retirement planning needs. So I know that we've probably covered that a little bit, but could you guys just maybe briefly explain what comprehensive or ongoing financial planning needs looks like?
Yeah, so you pay an advisory fee, based on the assets under management. So what do you get for that? You get a financial plan. We also have we look at your risk tolerance. We have a way of profiling that, right? So in your plan, we know the rate of return that you need to achieve your goals, and we want to make sure you can sleep at night. That has to all fit together really well. And then what will happen is there's a lot of other planning issues. We have these 5 levers. When you're going to retire, how much you're going to spend, how much you're going to leave, how much you're saving, and the risk you're going to take. So those levers we have control of, and based on the changing market environment, based on changing goals, we have to keep on updating the plan and make sure then the investments are fitting into a plan. So it's an ongoing, very dynamic process.
Yeah, I think a good way of maybe stating that slightly different would be if you have what let's call a what if question related to your financial situation in retirement. That's what ongoing needs look like.
That's a great way of
what if I retire 3 years earlier? Right. What if I spend more on that home in Florida? What if I don't want to work part-time? How much longer? It's anytime you have those what if questions, that can be modeled into a plan. At the end of the day, we're not here to tell our clients what path they should go down. We're goals-based financial planners. They tell us what their goals are, and we tell them whether it's feasible or not. And if it's not feasible, like Ron said, there's different levers that can be pulled to make the plan, the probability of success better. And so we see what trade-offs, they're willing to make.
We look at the trade-offs.
Yeah, and that's just that's probably not a conversation that you're getting under the or having under the hourly model. If you're going to somebody for a specific period in time, you need to be more clear on exactly what that vision of retirement looks like. And if it changes, that's fine, but then you're just going to have to re-engage them again because that plan that they originally created is just, it's meaningless.
And to make that more concrete, we can build the Nick's parents continuum of people who are suited for hourly versus not. So we talked about my dad, worked for him. My mother could not work on an hourly basis with someone. She doesn't know anything about investing or financial planning, doesn't listen to the show. And she doesn't, more importantly for her, this isn't true of everyone who needs an advisor, but for her, she doesn't want to know. She wants to hire someone that she speaks to regularly, that she can offload the heavy lifting of all the thinking, and will come to her with analysis that she knows is good, and that will be able to tell her, yeah, this is what you want to do, you can afford to do it. This is our recommendation for taxes. And then someone who will also hold her accountable for implementing it ultimately as well, as you talk to. She's on the extreme other end. A lot of people want to be more involved than she would. But, if you visualize those two extremes, you can kind of start to place, where you are from someone who's basically does financial planning as a hobby, very good idea of what they need to pay for on a per project basis, to someone who literally paying to delegate it is a value add for them.
And by the way, the accountability or the implementation is so important.
Oh my God.
Mm-hmm. And what we do is we will recommend certain things. We send an email with our recommendations, and then we give ourselves a reminder for the next meeting. Did they do it? And if not, let's get it done.
We have to have a conversation about it.
Exactly, right.
I always say that, if you're going to be the DIY person, you need to have 3 characteristics.
Do it. Explain DIY.
DIY is like do it yourself.
Yeah.
That's like investment management, planning. If you care about lowering your taxes, having the capability to actually do the analysis there as well. But you have to have the time to do it. You have to have the willingness to do it. You actually have to, like your dad, you said it's like a
he
passion
likes
project
to
for
do
me.
it.
Yeah.
He likes to talk about capital market expectations
Right.
with me.
You have to want to do that. Like this is our job. This is what we do every day.
Right.
You have to want to monitor your finances very often. And then on top of that too, you have to have the ability. Like there has to be some level of technical expertise there, so that, like I said earlier, when you need to know that this question or this area connects to all of these other areas, because if you just look at this one area and you just laser focus on that, chances are you're probably neglecting other areas of your plan.
Right. The ability comes down to experience and education.
You're right.
Okay. And so I'm sure everyone can relate to this. You start in a new job, or you start a new project. It can be a home improvement or anything. And the first time you do something, you make a lot of mistakes, but you learn, okay?
Yeah.
So by the time you do it for the 5th time, the 10th time, the 20th time, you get pretty good at it.
Right.
And so what you have to be careful of is that, you read some books, maybe you have the educational smarts, but not the experience, or vice versa. That could get you in trouble.
Right.
And you also need to have the discipline to stick with it.
Yeah, and a lot of times it's hard to know if it. And this is, I think, where it becomes subjective, and because there is no concrete, you're either going to see the value of the ongoing or you're not. And I think that's why it can be tough, because a lot of times, maybe if you're not doing something well or the best way technically, you don't really know that there's repercussions, because it's not you're not seeing that impact directly.
Exactly.
I know that's kind of hard to explain, but there could be a lot of skeletons in the closet.
Oh,
when
absolutely.
You really look at it.
I mean, you can, there's a simple thing I'm going to save on Pennsylvania inheritance tax, so I'm going to put my, our parents, my mother's is going to be in joint name with me. And that sounds like, oh, okay, you can transfer it more easily, but the problem is that you, all of a sudden, there's a stepped-up basis upon death, basically reducing the capital gain, and all of a sudden, by doing that, you're subjecting yourself to a capital gain which is higher than the inheritance tax. So you have to be really careful.
Right, yeah.
Schedule your complimentary review with Ryan and his team today. Just visit them online at wyzewealthadvisors.com or call 724-271-7019 to get started. That's 724-271-7019 to get started.
All right, so let's switch over to the model that we focus on with our clients, which is the charging a percent based on the amount of assets that you're managing, and that fee covers what we think is a very comprehensive offering, focusing on investments, retirement planning, and tax minimization planning or tax strategies.
Yeah, for our niche, I say the only things that we really don't do is we don't write documents, for wills and trust, right? We have outside experts for that. And then also we do extensive tax planning, but we actually don't do tax returns.
Right.
We also have people we can
Right.
refer you to.
Yeah, but we are, like I know you said it, but our network's pretty deep in that area, and a lot of the people that we refer our clients to, we actually work pretty closely with. So they really are an extension of the team. If we have questions about a specific
absolutely,
situation,
right.
we can reach out on behalf of our clients and do a lot of that communication back and forth, almost like as if we're working in the same office. It's really nice.
It's actually better than working in the same office, because unless you're a mega firm, it's hard to really afford someone, top talent.
Sure.
By having them on the outside, we have a vested interest to work together.
Sure.
We gain their expertise, they gain ours. It's
Right,
a perfect
exactly.
relationship.
Yeah. So the first pro to the percent based on the assets that you manage model that I want you guys to talk about is, how our interests financially are aligned.
Yeah, I mean, it's very simple. Like, if you look how someone's paid, right, you kind of know what their incentive is. So if we're paid based on the value of your portfolio, our incentive is to grow your portfolio over time.
And keep you as a client long term.
Right, and keep you, right.
Right, that's the thing I want to add.
Right.
We get paid quarterly, okay? So if the fee was, say, 0.8%, that means every quarter you're paying us 0.2%.
Yeah.
Okay? So if you're not happy with us, you can leave and take your money, and we would rebate if we charge you for a quarter and you weren't there for the full quarter. We would rebate you the difference.
Yeah.
And so there's nothing making you stay with us, right? So we have to do a good job on the planning and on the investments, because if not, you can separate from us easy. It's not like insurance where you get involved in insurance and the separations are very ugly.
Yeah, it's actually like it's actually so easy for somebody to basically remove an advisor from their account. Like
Sign a form.
We use Schwab as our custodian, and at Schwab, like, they're your accounts. You own the investments in those accounts. We are just on that account as a limited power of attorney, which only allows us to do two things. That's manage the money and bill on the account.
That's it. Yeah.
If you ever wanted, at least at our firm, if you ever wanted us separated from the account, weren't happy, didn't want to work together anymore, like you said, you could go directly to Schwab, de-link the advisor, your fees stop immediately, and if they went on any longer, you're rebated for them. So there's no contracts, there's no long-term commitments.
No surrender charges like with these annuity products.
It's really straightforward.
Yeah.
It's, are you happier as the advisor adding value? Great, you'll continue working together. Do you feel like they're not? Okay, then the decision is yours whether you want to continue working with them or not.
So the burden's on ours. And the other thing too is that we don't get paid a dime by, on the advisory side, we don't get paid a dime by any product we recommend, right? So you mentioned with the fee-based, there's less of a potential conflict because they don't offer products. Well, with us, since we don't get paid by our vendors, we only get paid by you, that eliminates the conflict as well.
Can you guys talk about how the percent, the model that we follow, can you talk about how that would be more convenient for clients?
Yeah, let me just take the big picture, and Nick, if you have anything to add. So what we do is we charge a percentage on assets. It starts around 1% and goes down. And as we have mentioned multiple times, it covers everything we're doing, okay? But what's really interesting is as your account grows, the next dollar becomes much cheaper and cheaper and cheaper. When you get to 2 million, 3 million, 4 million, it starts to go down very, very quickly. And how we have our fee structured is that the first 1% we're very industry-like. The first million we're very industry-like, and we're offering the planning and the investments. But as the money grows, we have synergies on the investment side, which we pass along. So our fees go down rather rapidly. And so what we're trying to do is price it appropriately for what we're doing and the value we're adding.
Right.
I think what the client is experiencing, though, on more of the qualitative side is, with that hourly model like we talked about, you have to basically, it depends on the specific arrangement, but in most cases, you have to go with a clear idea of this is what I need, this is what I want, and I want to sign a contract for this specific thing. With our model, we look at you, do all of our client onboarding, and we've proactively identified, based on your situation and your needs, what kind of services you're likely to need in a given year, and then in future years as well. So we're proactively thinking about which clients are suited to the Roth conversion strategy. And then for those clients, we have it integrated that in the fourth quarter of every year, we're doing the tax analysis and we're going back to them proactively. So there is a certain degree of client accountability, right, in terms of follow through on our recommendations. But in terms of developing the point and keeping the calendar organized and making sure that we're touching base and doing the analysis on all those things, it's happening proactively as opposed to reactively.
Right.
Yeah, I think that's a good point. Like, why I would say that it's more convenient is like at the end of the day, we at our firm, we have a multi-year documented client service model where we're proactively looking at how often we're reviewing this item, how often are we having review meetings for insurance, estate reviews, financial plans, we're reviewing that twice a year. That's documented. So for clients, they don't have to think about that part of it. Like, we already have that mapped out. The only thing that they really need to do is come to the meetings and tell us if anything's changed, or if they want to do something different with their money, or if they want to go down a different path, or if they want to
Most
live
of
a
it's
different
goals,
retirement
like if
lifestyle.
changing their goals, right? Yeah.
And then we obviously answer those questions through a plan, but then also make sure that the other areas of retirement planning aren't being neglected and proactively review those as well.
Right, and there's some, Nick said something that was really important, that like sometimes clients don't know what they need, right? So some client may say, hey, I might need long-term care, I might need this or this. Those are kind of like one-off projects. But sometimes, like, should I take money from my taxable account of my IRA, which is more tax efficient? Do I consider Roth conversions? Sometimes they don't know that should even be considered. And let me just give you an example. So if you go to see someone about long-term care, their recommendation is going to be buy long-term care. Okay?
That's how they get paid.
They're going to show you the reasons to buy long-term care. You come to us and say, hey, what do I do about long-term care? First of all, we put that in the plan standard, right?
Yeah.
And so what we do is show, okay, here's this potential cost in your plan. Let's talk about the ways we can solve that. Do we want to self-fund it, meaning out of your own money? Do you want to get a traditional long-term care policy? Do you want to get a hybrid policy? There's a bunch of different ways to fund it. But so what we do is we educate the client about the pros and cons of those different approaches, not just saying you always need to buy long-term care.
Yeah, and then the team of experts that we use on the insurance side too, let's say that one of our clients, even through conversations with us, decide they still want to entertain the idea of purchasing long-term care. Well, then that insurance team is going to sit down with them, have a meeting where they educate them on insurance. And actually, more often than not, when they sit down with them, they don't even end up buying a policy after they're educated on it. So
exactly.
It's education. It's providing you answers. It's showing you the trade-offs between purchasing or not, et cetera.
Right.
One more thing I want to talk about, a little bit separate from that I think is really important, is the accessibility that our model provides.
Sure.
So my prior role, I was involved in drafting some legal documents, helping come up with those, and we had outside counsel that helped us do it. You learn very quickly working with people who bill a lot hourly. Always fear picking up the phone for that 15-minute consultation on a question, because then the $500 or $1,000 bill shows up for the time. And it may not be that high with an hourly planner, but that dynamic can be in place where it's like, hey, I have a question about the market, or I have a question about how some tax law change I heard about in the news might affect me. And if you're going to get hit hourly to have that conversation, it may make you think twice about getting the advice or something like that. Versus, we had a new client that we're onboarding right now. She's concerned about the market this year. Emailed me earlier today. I responded to her with some data and some talking points, and also already sent her the link to say, hey, if you want to talk more about this, schedule a 30-minute call with me. I'm happy to go into more detail with you. That's the type of ongoing service we provide that's already embedded in what you're paying.
I mean, I have a client in Virginia that we're trying to do some elder law planning, and I just don't have an estate planning attorney in her area in Virginia. So, my clients are helping, like they're leveraging their network to, find some people that may have worked with ones, but I'm going to be calling these firms and setting up calls and asking them questions about my client's situation to figure out which firm I think is the most capable before I even introduce them. That's just like, that's outside of the, hey, we're just meeting twice a year to review your plan. That was a result of one of the meetings, so it's things like that happen all the time.
We make our calendar, we get together with people twice a year, and for
clients have links to our
on the planning
calendar.
side, right, but we always tell people, hey, when things change, call us, set up an appointment. So we'll go through periods of time where it doesn't happen, and all of a sudden it happens pretty often. That's okay.
Mm-hmm. Yeah. All right. What about some of the downsides to the percent based on the assets that you manage?
There are none.
There are.
There are none. That is perfect.
I mean, if
there's one low-hanging fruit.
Yeah, I think the downside is that the fee could be potentially higher than the one-off plan because there's more stuff that the advisor is doing.
Sure.
So
if you look at it cumulatively, I would say it's almost always going to be more expensive if you're working with somebody ongoing because you're probably working with them for several years.
I have client relationships for 20 and 30 years.
They're definitely paying more than they would be paying.
There's hardly any turnover at all, right?
Right, exactly. So in that sense, definitely could be more expensive.
But here's the interesting thing. Okay, so we were trying not to talk product before, but I just want to give you an example of something. So we use private debt. The private debt, the extra yield that provides on a balanced portfolio covers about half our fee. Just one investment.
And so why do you feel that that's significant for this conversation? Like saying the part about private debt specifically?
Well, I mean, when we put together a portfolio, we've talked about this in other episodes, but part of our portfolio is publicly traded, stocks and bonds, and part of it's private, right? Private has certain pros and cons. But what I'm getting at is we have some unique investments that are available. Private debt happens to have a very, very nice yield. There's some negatives to it, and you can look at other podcasts when we talk about it. But the gist is, because of that extra yield, literally, it pays about, again, half our fee.
Yeah. So that I know that kind of covers we're kind of flirting with the area of the conflicts, of the potential conflicts.
Yeah. So what other negatives can you?
Yeah, Ron mentioned this before, but it's worth highlighting again. We talked about how we keep our compensation on portfolios we advise on really clean. We charge our advisory fee, and we don't get paid a commission by the company that manages the private debt or the company that manages the ETFs that we use. There are some firms, and it's on the person who's looking for an advisor to research this and understand it. Some firms will charge an advisory fee, but then on the investment side, use products that pay them revenue as well. So obviously in that case, they're almost double dipping, or they are double dipping. Right. And you have to be careful because you have someone who's charging you a fee for advice, but then on the other side, they have a financial incentive to preference certain products over other products.
Right. Certain like mutual funds will have something called a 12B1 that might give a kickback to the firm, right? So that's a conflict. We don't get a dime of that. So we have a vested interest to look for the best product at the lowest cost.
Yeah, exactly. Because we're paid by our clients.
Yeah, we're fiduciaries. We're in the best interest role, meaning that we have to do what's in the best interest of you, not what's just suitable. Meaning,
and suitable could be, hey, a 60-40 allocation between stocks and bonds is suitable, but I'm getting an override on the portfolio. And oh, by the way, you're paying my firm maybe 1% for planning, and then the cost of my portfolio is, a half of 1%, or maybe even, so your all-in fees are like 2% maybe. I mean, it's just ridiculous.
And you see this I've seen it in my career. It directly impacts product selection. Low-cost ETFs, like the ones that we use, have been a huge advance for investors in terms of keeping their costs down on the fees of managing the strategies in the ETFs, and also in the tax efficiency.
Right.
There are many firms, because of that commission structure, that are stuck justifying using very expensive, tax inefficient mutual funds for clients because it blows up their revenue model to use a different product, even though that would be better for the client.
The last con that I would say to the percent based on the assets that you manage model really comes down to the time aspect, the time that you need to spend interviewing. Seldomly are people interviewing one firm, I would say, when they're thinking about hiring an advisor.
I would say that's fair, but also if you're going to find a fee for plan advisor, you have to shop them too. So I don't know if
You
it's
do, that's true. That's true. You're going to have to shop regardless. But I would say that the second part that I want to add to it is when it comes to interviewing advisors, a lot of firms are paying people to bring in new clients, and so it's easy for people to kind of talk the talk. They can get really good at saying, this is what's resonating with these prospective clients to get them in the door. But can they walk the walk? And you need to be able to, when you're sitting down with somebody that works with people in an ongoing manner, you really need to be able to compare, this firm to this firm and say, hey, this firm sounded good, but like really looking deep in their plan, like, are they being extensive or thorough with their assumptions, and like, what do they have in the plan? Like, what's their investment approach? Is it low cost? Like, all of those things need to be analyzed. And I think it's a little bit easier to just kind of maybe listen to what the advisor's doing rather than see what they would actually be doing for you. Yeah. And that takes some skill, it takes some time, some comfortability, maybe a little bit of gut feel. Anything you guys would want to add onto that?
One thing I'd like to add is that studies show that client turnover for the fee-based model is greater than for the model that we go under. And because, like Nick said, like if you have a fee-based model, you pay a fee, you get certain things done, and you might be not wanting to call and pay a $500, like $500 for a call. Studies show that clients prefer for an attorney, they charge a flat fee than to nickel and dime them every time you call and every time they make a copy of something, okay? And so if the turnover is lower with our way of doing it must mean that, clients like it in general more, okay? Yeah. And what's interesting is when at a previous firm we did a study, it's called Net Promoter Score. And what they're looking at with your clients, they interview your clients, they survey your clients, and what they do is ask, not only are you happy, but are you so happy that in the right situations do you promote your advisor, do you refer your advisor? And that's the highest compliment that can be made. Right. And I've been using the same model forever, and my Net Promoter Score was number one in the company out of about 70 offices, and it was over 90, which is like unheard of. I would never,
Isn't the industry average below?
Oh, it's like below 50. Yeah. I would never, ever be able to do that if I did it based on a plan, because I wouldn't have much communication. People would come and go, and so if my clients are that happy where they're referring people, it says something.
It does. I agree with you.
The one thing that I would say is just an important thing, and this applies if you're working with someone hourly too. It's back to that follow-through thing we touched on earlier. Like, if you're going to commit to an ongoing relationship, like, use the relationship. We will add the value with our recommendations. Like, we don't have any concerns about that.
If we didn't think we wouldn't have started working together in the first
Exactly. Place. But every once in a while you run into a client that for whatever reason just doesn't implement, and that's not a good use of their money that they're paying us.
No, it puts everybody in a bad spot. Right. It puts us in a bad spot because, at the end of the day, like, we're providing these recommendations. We want them to be implemented so that they can benefit from it. And if they're not being implemented, or if it's difficult for us to help the clients implement them, that's not like a good working relationship.
Yeah, this is one of the only times this has ever happened to me. But we actually had to write a letter recently to tell a client that unless they've provided us information so that we can manage their money, we didn't have cost basis. So if we sold, there would be huge capital gains. And all we needed to get is the cost basis information. We could help, build it for them, right? And it wasn't provided after 2 years or whatever. Yeah. And so we were managing their money ineffectively, and we knew it, and we told it to the client.
And we were proactive about telling them.
Exactly. We told them multiple times to the client. Finally, we said to the client, like, if we don't give us this information by X date, we have to delink you. And the client decided to go on their own.
Yeah, it crosses a certain threshold where you're like, this is no longer in service to them.
So we're not going to collect a fee if we can't add any value. Right. And that was so obvious.
Yeah. No, I think Ron said it very well. I mean, there's a lot of firms in that kind of situation. That story is so good because it touches on the fact that, like, that cost basis seems like a minor detail, but it has huge implications for the rest of the plan in terms of the recommendation.
I mean, that could have been, I forget the amount of money was involved, $300,000 or $400,000, but that could have been
and the
a tax of like
hundreds of thousands of dollars.
I mean,
capital
yeah,
gains,
well,
right?
at that 20% or whatever, I mean, you're looking at maybe, $60,000, $80,000, $100,000. I mean,
yeah.
so I'm not going to suggest sales until I know and I can convey this is what it means to you, right?
Yeah. Well, I hope that, for those of you listening, I hope that you found this helpful for us to kind of paint the picture on both sides. And if you are out there interviewing advisors, hopefully this provides you with a, better background knowledge on maybe some questions to ask or things to look for. But if you like the content that we're putting out there, please just give us a like, subscribe, and please don't hesitate to check out our website, www.wyzewealthadvisors.com, and Wyze is spelled W-Y-Z-E. Thanks for tuning in.
This episode's content is for informational purposes only. Opinions expressed herein are solely those of Wyze Wealth Advisors, unless otherwise specifically cited. Material presented is believed to be from reliable sources, and no representations are made by our firm as to other parties' informational accuracy or completeness. All information or ideas provided should be discussed in detail with an advisor, accountant, or legal counsel prior to implementation.